Hi, good evening, everyone. Thanks so much for joining tonight's Corporate Connect with iFAST Corp. The webinar tonight is organized by SIAS and supported by the SGX Group. My name is Gerald, and I'll be your host for tonight. So for many of you who are actually users of the FSM1 platform, you'll probably be very familiar with iFAST. The wealth management platform actually offers access to over 20,000 investment products. And the company has assets under management of more than 19 billion as of 30th September 2023. So what we'll do today is actually have the company representative share with us a presentation on some of the recent corporate developments. But before we do that, we'll kick off tonight's webinar with a presentation by Ms. Lee Ji-hei, who is a research analyst at the SGX Group, and she'll actually brief us on some recent market highlights. Thereafter, we'll have a corporate presentation by Mr. JP Wong, Executive Director at iFAST Corp, and that will thereafter lead to a Q&A session where we'll be happy to be taking your questions. So without further ado, I will now invite Ji-hei, who will give us an overview on how the Singapore market has performed in recent months. Over to you, Ji-hei.
Thanks, Gerald. First, I'll share my screen to get started. Can you see this all okay? Great. Thanks, everyone, for joining us. My name's Ji-hei Lee. I'll be going through some recent highlights that we're seeing in the Singapore stock market today. I hope this background will add a little bit of context and color into how iFAST Corporation has been doing as a leading name in this global digital banking and wealth management scene, not only here in Singapore, but also across the globe, especially as we navigate these really interesting developments in the market. My presentation will be threefold. First, I'll be highlighting some of this recent economic developments that we're seeing, secondly, how some sectors, in particular the tech sector, has performed recently, as well as touching upon certain themes and looking ahead to next year. So as we're now into the first few trading days of the final month of 2023, I'd like to give you a recap of how the stock market here in Singapore performed in November. And we start with our benchmark index, the Straits Times Index. As you know, it's made up of the top 30 companies listed in Singapore. It serves as a representative of the wider Singapore stock market, of course, and some of its largest sectors being financial, consumer, healthcare, tech, and commodities and resources. But what we saw in the month of November is really this reversal of some of the steep losses that Singapore-listed stocks saw in October. The month of November saw stock indices across the world overall rally, with some posting their best months of the year, although with the exception of Hong Kong and China. The Straits Times Index, meanwhile, recorded gains of 0.7% in total returns, inclusive of dividends. Sectors that outperformed were utility stocks, REITs, and technology stocks, with an average of 9% of total returns. And the best returns were seen in Sembcorp Industries, Fraser's Logistics and Commercial Trust, and Maple Trees Logistics Trust, and these three averaging total returns of 12%, 10%, and 9.5% respectively. Now on the flip side, the declines were led by the telecommunications sector, real estate stocks, excluding REITs, and consumer non-cyclicals, which averaged declines of 0.6%. Another interesting part about what we saw in the market over the month of November is this heightened interest in basically China's growth story. Despite China and Hong Kong equities lagging behind its regional peers, with especially some of the economic data coming out of China portraying slower growth than anticipation, we saw a much heightened interest over exchange-traded funds, or ETFs, garnering about more than 400 billion yuan. That's about 75 billion Sing dollars this year. It set record annual net inflows, and this is according to mutual fund house China AMC. Now, we're also seeing that being reflected in the products listed in Singapore as well. SGX listed ETFs with China equities as underlying was the second most active asset class in the month of November, with a turnover of about 47 million Sing dollars. Now, in terms of the most recent week, our research team here at the Singapore Exchange, we tracked the fund flows for the 100 most traded stocks. Here on the left-hand corner, we see stocks that institutional investors have bought, which we can see as iFAST Corporation is one of the top 5 Insti net buy stocks. So for the month of November, institutional investors net bought 41.6 million Sing dollars of Keppel stocks and 7.6 million Sing dollars of iFAST Corporation stocks. And this chart over here on the right shows the top 5 stocks with the greatest increase seen in daily volume. This includes stocks that have a minimum 3-month average daily value traded of 1 million Sing dollars. And the volume variance seen here represents the percentage variance rather of the previous week's average daily volume traded in comparison to the 3-month average daily volume. Another note worth adding here is the full year of 2023 so far. iFAST is the number 6 top traded tech stock in 2023 in terms of daily value traded. It received more than 46 million Sing dollars of net Insti inflows so far this year, and it's the second top tech stock in terms of net Insti inflow. Another interesting development worth looking into is one economic indicator for Singapore that was released in the past couple of days. That's really telling of how the tech sector is doing. And that is the industrial production growth or volume of output generated by industrial sectors such as mining, manufacturing, energy, public utilities. And as you can see here on this top right corner chart, we saw this continuous months of contraction here. Singapore actually saw 12 consecutive months of its manufacturing output contracting year on year. But in October, it grew by 7.4% year on year, marked the first year-on-year expansion since September 2022, defying expectations of seeing a decline of 2.1%. Now, this IP data was driven by nearly a 15% year-on-year jump in electronics. And also, this move was reflected in the Singapore stock market as well. The tech sector in the stock market saw the highest net Insti inflow. Key names including Venture, iFAST, Aztec Global, Franken, and UNS. And some interesting developments on the corporate announcement front here in the bottom right corner, as I've summarized here. Some names that stood out in particular, of course, iFAST. Its latest earnings were extraordinarily impressive and really telling of the turnaround for the tech sector. Its profits surged 308% year on year to 8.5 million Sing dollars. Also worth noting is this was also driven by its Hong Kong operations, which I touched upon earlier slightly on investors having this heightened interest on the China growth story with the ETFs. Aztec Global also provided business updates recently with its third quarter revenue improving by 17% and driven by Internet of Things devices and products related to data communication. And of course, we really can't talk about the year of 2023 without the rise of artificial intelligence and the application of it. The overall global interest really speaks volumes about what's been on top of investors' minds. One indicator that I'd like to hone in on in particular is the iEdge Artificial Intelligence 40 Index. For those who don't know, this index tracks the performance of 40 US listed securities that are involved in artificial intelligence, either by providing relevant hardware solutions, software, algorithmic, artificial intelligence solutions, or are engaged in the industrial applications of AI. And as you can see, this consistent growth reflected in the chart here are the returns of these 40 companies that the index tracks. It's quite telling, and there are 3 major significant developments that we've seen in this sector, particularly related to the Singapore stock market. First of all, this slump in semiconductors that we saw earlier, it's really likely to benefit from that extra boost we've seen earlier with the increase of AI demand. Overall, markets are expecting to see that rebound from between 2024 to 2026, with projected chips growth reaching up to $1 trillion by 2030. And that's according to McKinsey & Co. That's up about 70% from approximately 600 billion seen in 2022. We've also seen numerous companies listed here in Singapore, including the likes of AEM Holdings, as well as iFAST, who has recently unveiled the iFAST Global Hub AI, the artificial intelligence based digital hub in Malaysia, in order to expand its global presence in digital banking. So definitely worth watching for the developments on that front as well, and what that means for the wider tech sector for institutional and retail investors here. Another thing was a development that took place yesterday, actually. The DPM Lawrence Wong announced yesterday that Singapore is pledging to triple its workforce in artificial intelligence to 15,000 under Singapore's national AI strategy. So definitely a very interesting sector to keep close tabs on. And lastly, what I want to end on here is that 2022 and 2023 even were quite interesting times, to say the least. We did see a lot of resilience in terms of the market, as well as the companies listed here in Singapore throughout this period, especially some really making a comeback with the tech sector at the forefront of it all. And that resilience is also seen in the Singapore economy. The government predicts the economy could grow up to 3% next year. Now, this outpaces the prediction made by IMF for global growth in 2024, which is at 2.9%. We've also seen Singapore rank the top side by side with Zurich for EIU's most expensive cities list. While that may not be the best of news for some, but it could be really good news and really revenue generating for the wider market, of course. And in this government's projection for next year's economic growth, they also mentioned the rebound in the tech sector, also known as this risk-on factor. So we could definitely be looking at a very interesting year for retail investment ahead of us. Also worth mentioning is the full reopening of China taking place earlier this year. The tourism sector is likely to continue reaping the benefits of that, with air travel and tourist arrivals likely to support aviation and tourism related sectors here in Singapore, as well as consumer-facing names, including retail trade and, of course, the food and beverage industry. Another major development to factor in for the coming year is the potential that global interest rates could start to moderate, despite how the current market is pricing in a higher for longer rate environment. When the Fed and global central banks do start cutting rates, and some parts of Asia, like Vietnam, have already started that course, this could definitely benefit Singapore's finance and insurance sector. And of course, we have risk factors such as further geopolitical tensions between China and the US, over in the Middle East, as well as Ukraine and Russia. But with all of that considered, there's definitely lots of investment opportunities here in Singapore with the upcoming year, with moving parts all around. And this concludes my part of the market update session of today's Corporate Connect webinar. I'm very much looking forward to JP's section of what he has to share about iFAST. And if you have any questions, feel free to reach out to Gerald, me, or anyone here. Thank you. And I'll hand it back over to you, Gerald.
Thanks so much, Jihei, for the update. I think with that as the backdrop, everyone is very excited to hear directly from iFAST why so many institutional investors have been buying into your stock over the last week of November. So maybe you can share with us a corporate update and what are some of the key initiatives that the company has undertaken. Over to you, JP.
Yes, thank you, Gerald, for the introduction. And thank you to SIAS for having iFAST tonight, and good evening to all our investors and participants in this presentation. So I'll run through some of the key points that we have shared with our investors following our third Q results, which was at the end of October. I'll try to keep it quite short so that we have a bit more time for Q&A. So I'll just run through some of the key points. So one of the key metrics for us at iFAST is to see how our assets under administration, or AUA, grow. So as at 30th of September this year, our AUA hit a record high level of 19.12 billion Sing dollars. So that's a 1.7% Q-on-Q increase and a 12.6% year-on-year increase. So all this has happened amidst volatile market conditions. And also it was encouraging for us to note that net inflows, which takes into account the amount of sales into the various investment products we have, minus the outflows from those investment products, that number, the net inflows number, remained positive and in fact increased quite well by 34% Q-on-Q to $751 million in third Q 2023. And for 9 months of this year, our net inflows were positive at a total number of 1.62 billion Sing dollars. Our non-banking operations continue to show strong growth in third Q and 9 months of this year. So net revenue numbers grew strongly by about 37% year-on-year to $38.4 million in third Q, while profit before tax increased by 141% year-on-year to $13.27 million in third Q. On a year-on-year basis, net profit grew by 149% and 57% in third Q and 9 months 2023 respectively. As you've noted as well, the Hong Kong ePension division made an initial 1-month contribution during the quarter, and that has helped to drive the contribution from our overall Hong Kong business in third Q numbers. I won't go through the next few points, which touches quite a bit on the numbers, but just the last bullet point on this slide, on the first slide just now, is on the bank. So even though the banking operation, which is the iFAST Global Bank, it's still in the initial build-up stage, the group is seeing encouraging progress from the various metrics at the bank level. So net revenue from the bank operation grew 49% year-on-year to $3.3 million during the quarter. And that's largely driven by our new divisions of digital transaction banking and digital personal banking. Those are new business divisions that we have launched since the acquisition of the bank, which was completed in March of last year. So deposits and balances of customers actually grew pretty strongly by about 140% to $232 million as of 30th of September this year, which was a big increase from the $96 million as of end of last year. So moving on to the next few points. So we expect overall revenue and profitability to show marked improvements going forward. We expect profitability in 2023 to be substantially better than last year, and the revenues and profitability going into 2024, we're expecting that to show robust growth compared to 2023. So the expected improvements will come because we feel we're making good progress on our 3-year plan, which I'll talk a little bit more about later on. And the profit contributions from iFAST Global Bank are expected to still be negative in the next 3 quarters. However, we expect iFAST Global Bank to play a major role in the growth of the group in the medium to long term, especially beyond 2025. And for third Q of this year, the directors have declared a dividend of 1.3 cents per ordinary share. So it's similar to third Q of last year. So let me move on to just a few other slides before we go to Q&A with Gerald. So this slide, we have it every quarter. It shows the AUA for us. As I mentioned just now, it grew to a record high of $19.12 billion as at end of September. And if you look at the split between our businesses, about roughly 70% comes from the blue part, which is our business-to-business or B2B business division. And the remaining 30% comes from our B2C business division, which is represented by our FSM1 brand. So moving on to the net inflows and also the gross unit trust subscription, I think if we look at the third Q numbers, especially the net inflows were especially encouraging compared to the first 2 quarters of this year. And for the total of this year, for the 9 months at least, we're at $1.6 billion for net inflows. So that's the number that's interesting for investors to look at because net inflows adds to our AUA. And of course, the market effect, meaning the conditions in the markets also will, make our AUA levels change. But if net inflows are positive, then that adds to our AUA numbers. And also, when I look at the unit trust subscriptions, that has also been encouraging because unit trust continues to be the core product we distribute at iFAST, because that's how we started our business, even though we've added a lot of new products in recent years. So, of course, UT subscriptions have been pretty solid as well. So, for 9 months of this year, we're at $3.3 billion. I won't really go through the numbers in the financial results because I've mentioned it briefly, and also GH just now mentioned a little bit on our profitability. What I just wanted to wrap up with was really some of the goals and also the vision that our management team are looking at. So this slide shows our iFAST 3-year plan, and it's supported by 4 main pillars. So the first one, the core platform business, to make it bigger, better, and more profitable. So basically what we're trying to say is we will continue to work on increasing the scale and quality of our fintech wealth management platform in the various markets we are in. And one of the numbers for investors to maybe look at, it's really this target AUA of $100 billion that we have been mentioning to investors by 2028. And of course, with that, we also want to improve our operating margins and return on equity. So the wealth management business is really the one that we have created from the year 2000. So this year we're 23 years old. The newer business divisions would be, of course, the banking side and also the e-pension. So the second point is touching on the e-pension. So essentially, what we want to share here is to accelerate Hong Kong business growth and effectively deliver on the e-pension services over there in Hong Kong. I'll talk more about it later. The third point is about developing our digital banking services and other adjacent capabilities that can help to make our wealth management platform stronger. And fourth point, it's really with that vision of having a truly global business model in terms of servicing customers globally. So let me maybe go into the wealth management business first. So I think in the last couple of years, there's been concerns on markets and also macroeconomic concerns, some of the geopolitical concerns as well. And the good news for us in recent times is that some of our business divisions, despite those investor sentiment being quite poor, some of our business divisions have actually achieved record high, leading to the overall record high AUA levels. So, for example, the overall AUA for our Singapore, Malaysia, and UK operations have hit record high levels during the Q of this year. We have also seen an encouraging trend in terms of the fixed income products turnovers. So I think our investors have been keen to invest into the various fixed income products that we carry. So that would be including the various government bonds and treasury bills that we carry as well. The AUA for stocks and ETFs also achieved record high levels during third Q. So I think that's encouraging for us, that it's not just interest coming in fixed income, but it looks like the appetite from investors for equities is also returning to some extent, which is encouraging. Some of the new products and services that we have launched in third Q of this year. So, for example, we have opened up access to a new exchange, which is the LSE. We have also launched this new product, which is a cash solution product in USD, which we call the US dollar auto sweep. So we first launched it on FSM1 Singapore in July of this year, and we have subsequently launched it for our B2B and our iFAST Global Markets divisions during the third Q quarter as well. So this slide basically shows the fixed income turnover, and third Q 2023 number was really solid. It shows a big increase in terms of the turnover numbers. So the next slide shows our e-pension division progress. So we've started to see contribution from e-pension in third Q, and I think that's previously what we mentioned was that improvements can be expected for overall revenue and profitability starting in second half of this year. So I think we've seen that Hong Kong e-pension contribution starting to kick in, and that will continue obviously going into the next few quarters. There were some updates that we shared also from the ePension site, which is the sovereign entity that is in charge of the pension services in Hong Kong. So I think a few things here in this paragraph is that they expect the targeted timeframe for the onboarding to the new digital ePension platform or the eMPF platform to be in the second quarter of 2024, and also full operations to be in 2025. But for us, and also for the various partners working on this e-pension scheme, there's been already, quite a number of work done on the software updates, and also quite a number of testing being done in the last few months. So I think that's how you see the contribution starting to kick in as well for us. The other point related to Hong Kong pension services is that besides the MPF pension scheme, there is another pension scheme in Hong Kong that is called ORSO, or what we call also. And sometime in June of this year, what we shared with the investors is that we also expect the ORSO e-pension to start making sizable contribution to our Hong Kong AUA, but at a later point from 1st Q 2025 onwards. So this also pension scheme, it's something relatively new, and also we expect that we have gotten business and partnerships with a trustee, and the contribution from that business will kick in from 1st Q of 2025. And these are some of the Hong Kong targets that we have been sharing with shareholders since sometime last year. And I think the last slide would be on the bank. I think we also have some questions on it. So really, we've launched a number of initiatives. So one is the digital personal banking, which is direct for consumers in terms of opening an account with the bank. The digital transaction banking is a little bit different, more of a B2B initiative, but both have been launched in the earlier parts of this year. We've been encouraged to see, some of the take up to be positive, and also it's been starting to add positively to the AUA as well. The other things on this slide I would probably share is that on the DPB, for example, we have received a bank account opening applications from a lot of new investors, so not necessarily existing investors. So that is actually a positive point to note. So we are able to therefore attract a new breed of clients as well to use our services, and hopefully they will be excited to then use our other services. I would say probably I'll wrap it at this slide, and I'll maybe get Gerald to bring in some of the questions that our participants have. Yeah.
Okay, thanks so much for the informative presentation. So we'll now move on to the Q&A session. For the participants who have joined us today, feel free to submit your questions in the chat. You can actually see the Q&A box. Just feel free to put your questions in there. If you have actually joined us via Facebook or Momo, you can click on the link to join us on Zoom and post your questions on Zoom. And then thereafter, we'll try our best to be answering as many questions as possible. Okay, so there have actually been a few questions submitted. I'll actually start with one that allows us to understand iFAST better. So like I mentioned earlier, you have quite a number of very faithful FSM users on today's session. So I think what they want to understand, I think this question is, for someone who is on both iFAST Global and FSM, as well as a shareholder of iFAST, can you help us to understand what's the difference between iFAST Global and FSM, and how do I differentiate between the two?
Yes. Thank you for all our clients as well for joining this webinar. So the question is on the differences between FSM1, our business to clients or B2C business division, and IGM, or what we call iFAST Global Markets. So the key difference between the two business divisions would be FSM1, very briefly, it's focus or services more of the DIY clients. So these are clients who are happy to open an account online on their own, and then they start to trade on their own. So they require a relatively little advisory support from our advisors in that sense. Whereas the iFAST Global Markets business division is a newer business division we created about 4 to 5 years ago in the various markets that we operate in, and they are actually they have a number of advisors. For example, in Singapore, the IGM business division has about 60 advisors, and they therefore then service clients who need a lot more advisory support and hand-holding in that sense. So that would be the main difference between FSM1 and IGM.
So effectively, you have a different service for different investors, really depending on what they're looking out for.
That's correct, Gerald.
Okay. So I think one of the points that you mentioned earlier was around the inflows that you have started to see in recent quarters. Maybe we can understand a bit better what are the trends that you see in terms of the AUA. Are there particular asset classes that is driving more of the AUA growth? And how do we expect the trend for AUA going forward?
Yes. I think in recent times, let's say if you look at the last 1 year when the interest rate cycle started to turn and when interest rates started to increase, the last 1.5 years also, then I think that also coincided with markets being a lot more jittery, especially equity markets globally, especially from the US. I think closer to home as well, if you look at Hong Kong and China markets, then the sentiment has been relatively poor. And I think what we have noticed then is investors have been a little bit more risk averse. So for some of them, they would prefer to go for asset classes like fixed income because they can get relatively decent returns on risk-free assets like even your Singapore Treasury bills that they can buy on our platforms. So I think that that is kind of reflected in in that slide that we have in the fixed income turnovers. And also, of course, besides being able to buy, let's say, sovereign bonds or corporate bonds on our platforms, even if they buy, let's say, unit trusts, the interest in some of the money market or short duration bond funds has also been higher compared to, let's say, the previous years. But of course, generally for us, our investors are also very keen to maybe look at how to make money in equity markets. So there's still that interest in some of the sectors like US tech, semiconductors. I think GA mentioned as well about the semicon sector. So I think that there's that interest among our investors. But it's just that relatively speaking, I would say, with sentiment being more jittery in the last, let's say, 1.5 years or so, then fixed income has been a relatively a popular asset class. And for us, when we look at it, we wanted to see whether we can add improvements to some of the products that can help clients during these times. So one of the products that we launched was the US dollar auto sweep in July of this year. Because I think if you look at the net yield on that product, it's about, let's say, in the region of 4.7%. So it's something quite decent for clients who have US dollar spare money or idle cash in USD. Then they just park it there, earn the 4.7% per annum, and then they can deploy it to buy into US stocks or ETFs. When market opens on the US in the evening. Or even if they need it on a short-term notice because of the short T+0 redemption and settlement cycle. So those are some of the innovative features we wanted to introduce for that product. Yeah.
Okay, thanks so much for sharing some of the drivers of the AUA growth. There's this question around who do you consider to be your key competitors in Singapore, Hong Kong, as well as the UK?
Yeah, I think for us, when we started our iFAST business in the year 2000, the competitive landscape has changed quite a bit compared to today. But essentially, in terms of who we see as the main competitor, it's pretty much the same, and that would be the banks. And the simple reason for that is that a lot of deposits, a lot of wealth management money flow to the banks. The penetration of the banks in terms of where we put our money in deposits and savings accounts, it's extremely high in Singapore and even in the other markets we're operating in. So I think if we are able to demonstrate that our services can be better to clients, in terms of the wealth management solutions we provide, in terms of some of the new services we launch, then we hope we can grab more market share from the banks. Yeah.
So related question from Jack, how do you see competition from other wealth platforms?
Yeah, I think competition is something that we see as something that will intensify. I think in a wealth management center like Singapore, which is able to very efficiently attract a lot of new players to operate here, then we can only assume that competition will intensify, and therefore we have to be, prepared to improve the solutions we can provide. So, the main competitors, as I shared just now, would be the banks. But of course, there are also other players like some of the stockbrokers, some of the other platforms that can also provide competition to us. But generally, if you look at it from a very high level, a lot of the deposits and AUA in cash is really, or even in the wealth products like unit trust, that's actually residing in the banks. So it's back to how we can demonstrate higher value to our investors. And it's not just investors on our FSM B2C platform, but it's also how we can help our B2B partners as well, because they also will try to grab, more AUA and more clients. Essentially, also at the end of the day, we think mostly from the banks as well.
Okay, so I guess that will lead into this discussion about B2B. There's this question from Mr. Huang around the very high contribution that he sees from your B2B business. So maybe you can help us understand what are some examples of B2B services you provide beyond your Hong Kong expansion.
Yeah. So we created, the management team created iFAST in the year 2000. So we started with the B2C business division that we used to call Fund Supermart because it's a supermarket of funds. Then after that, we rebranded it to FSM1 because we carried more products like stocks and ETFs and bonds. But 2 years after we started FSM1 in the year 2000 in Singapore, in 2002, the management team at iFAST saw an opportunity to create the B2B business division. And that was really because there was new legislation happening in Singapore that was going to lead to a new financial entity being created, which is a financial advisory companies, or what we call the FA companies. So the management team at iFAST saw the opportunity to create a platform that can service these B2B FA companies to run their business efficiently. Because these FA companies, a lot of them used to be insurance agents, but if they want to become an FA company, they need to have a platform that can connect them to the products. They also need a platform that can provide the infrastructure that can make their orders in the products be routed from clients all the way to the product manufacturers. So for example, for unit trust, if I am a FA company owner and I have clients who want to buy unit trust, I will, be connected on iFAST platform, and iFAST will consolidate the unit trust orders on a daily basis, then route those orders to the product manufacturers, which is the fund houses. Of course, today the B2B platform has also evolved to be an even more powerful platform. It has other products, including bonds, stocks, and ETFs. So the FA companies can also advise on these wider range of products. So we have the ability to make business easier or more efficient for the FAs by providing this platform with multiple products and services. Of course, that comes also with the IT infrastructure. I think it is crucial for any B2B player like a FA company to know that they can rely on a B2B platform that has solid fintech solutions. Because as I think most FA companies at some point, they want to have the ability to service their clients more efficiently using the web, but also on a mobile app, for example, because times have changed. It's not just a web solution that works, it's also mobile app and so on. So if they are connected to iFAST, we are able to provide those fintech solutions and innovations to them. We also provide compliance services, research services. So it's a very one-stop kind of a platform that enables these FA companies to really thrive in the wealth management space. Of course, in recent years, our B2B platform has also grown and expanded the kind of clients we onboard. So in the early 2000s, I mentioned a lot about FA companies, but in recent years, as Singapore's wealth management status also, grows, then there have been other players that have also onboarded, we have onboarded that are different. So some of them could be stockbrokers, some of them could be family offices, some are actually insurance companies with financial advisory businesses that have signed up with us on B2B. And compared to, let's say, a B2C business division, B2B, we tend to see it as having higher scalability, because for us, we don't need to hire all these advisors who are working at the FA companies. They are not on our costs because they are not our, employees. But we are able to scale up in terms of how many we sign up, and then they then, do all the wealth management solutions and selling to their clients. So that is the scalability of the B2B model. And the other thing to note is that in some developed markets like the USA or even Australia, B2B platforms are quite established or fairly common as well. But when you enter, Asia, it's actually very rare to find a uh, very solid or competitive B2B platforms. There are very few in most of the markets we operate in Asia. And that, of course, then gives us a competitive advantage.
Okay, I think there's a follow-up question on your earlier comment around the market share of the banks versus yourself. I think this participant, Melvin, would just like to understand better what's your estimate of the market share held by the banks versus your own?
Yeah, it's very difficult to pinpoint a number to it. I think because of a couple of reasons. So firstly, there are no independent kind of surveys or studies in Singapore that can tell us what's the market share of the bank when it comes to wealth management solutions. And also today, iFAST, we have broadened our products to not just be a unit trust provider. We also have other products like stocks and ETFs, and then therefore that comparison becomes a bit more, even more complicated. But I would say if you look at even unit trusts, if you look at, let's say, some of the reports. So one report would be, let's say, the MAS annual report. Then if you look at the unit trust amount or AUM that's available in the marketplace in Singapore, our current unit trust AUA in Singapore, it's still at a low fraction or a tiny fraction, I would say, of the total unit trust AUM in Singapore. Yeah. And where does the rest of the unit trust AUM come from? It's really from the banks and the insurance companies. And that is one example. I think if you go into other products like stocks and so on, like I said, it's a bit difficult. And then the competitors change a little bit, because if you look at, let's say, SGX turnover in stocks and ETFs, then some of the larger retail players will be, some of the stockbrokers, not necessarily the banks. Yeah.
Hey, thanks for sharing your insight around how we can understand the competitive landscape better. So going back to what you shared earlier around the target to have 100 billion of AUA by 2028, now that we understand your B2C business better, your B2B business better, how do we think about what is the key driver of growth towards achieving this 100 billion target?
If I look back at our core businesses, so we have the wealth management business. So we would expect wealth management in the various markets we operate in to continue to grow. Because we want to grab more market share. We want to make sure our solutions keep improving so that we can attract more clients to want to invest with us, whether it's on B2C or B2B. So we would expect the contributions therefore from the various investment products, unit trusts, stocks, ETFs, bonds, to also contribute to that 100 billion target. The other number, of course, or contributor to that AUA would be the cash part of the business. Even today, without being a bank in the Asian markets that we operate in, we have cash AUA which amounts to about 5% of total AUA. And the reason is because iFAST is operating on a pre-funded model, meaning that our clients have to put cash with us first in the various cash accounts before they can start to invest into stocks and ETFs and so on. And therefore, naturally, then we have some cash AUA. And as our wealth management product or platform continues to expand and grow, then we would expect that cash AUA contribution to grow as well. But now we also have a digital bank in the UK, so we would expect that bank to also contribute to that cash portion in the next few years towards our target. So that's broadly how we would look at it. In terms of exactly which markets or which products would grow the fastest and so on, we didn't give to that kind of level on details. But if you look at how we have grown over the last 23 years, Singapore continues to be the largest market contributor in terms of AUA. It's about 72%. But if you look at the smaller markets, they've been growing pretty well, especially in Malaysia. We've been able to we find that the competitive landscape in Malaysia is relatively less robust or maybe less strong as in Singapore and Hong Kong. So in that sense, we've been able to grow our AUA relatively quickly over there. So those could be some of the contributors at the geographical analysis level. And of course, others is still quite small today because, the UK bank is relatively new in our ecosystem, but we have hopes that the bank will be able to continue to deliver on its initial, promising results in the last couple of quarters in terms of getting some of the client accounts and also some of the deposits to go up. Yeah. So broadly speaking, that's how we will look at it.
Okay, so since you're at this slide, we shall shift gears a bit and talk about the other important market, which is Hong Kong. I think for those of us who are in Singapore, maybe you can start by helping us to understand a bit better what exactly are you doing for the e-pension services?
Yes. So for Hong Kong, we have a wealth management division that we created around the year 2007. So it's very much like what we have in Singapore with the B2C FSM1 and the B2B platforms. But in January 2021, roughly, the pension authorities in Hong Kong wanted to digitalize their pension platform. So that pension platform is called the MPF, the Mandatory Provident Fund. So equivalent example in the local context would be our CPF. But of course, they do have some variations in terms of the contribution rates and so on. But in Hong Kong, the MPF is the larger pension fund for the employees and the workers there. It's a scheme that has been operating since the year 2000. But it's a very non-digital pension scheme. So the authorities in Hong Kong wanted to look for a consortium of partners that can digitalize this scheme for them and for Hong Kong pension workers. And iFAST Hong Kong was part of the consortium that is part of the winning team that won the tender. So that was roughly about early 2021. So since then, what has happened was we've been working hard. Our iFAST Hong Kong teams have been working hard to ensure that our pension solutions can be delivered in the coming months. I think the pension authorities in Hong Kong have mentioned that they would like to commence onboarding in second quarter of next year. So the commencement of all the onboarding, it's expected to happen very soon. And this e-pension scheme, it's fairly large because in Hong Kong, the MPF AUM, it's in the region of 1 trillion Hong Kong dollars. So it's about 200 over billion Sing dollars. So it's fairly large. And in terms of how we get revenue for delivering our user administration services, essentially relying on our knowledge in Fintech plus funds administration, it's actually like a service fee in terms of what we earn. So this service fee is, you can look at it as if we provide those solutions and services properly and efficiently, we get those solutions, those service fee in terms of revenue. And it's a service fee that is fairly predictable, and it's for the next 7 years. So it's not dependent on, let's say, market volatility, like, investments going up and down, like our AUA. So in that sense, it provides a fairly a good cushion in terms of revenue streams for us in the next few years. So I think that's essentially the e-pension, and why it's so important for us, because we felt it was quite important for us, in fact, last year, to share some of these numbers to our investors, just to give them certain perspectives on what that project means. But of course, this slide here that we're showing, it's for the whole or total Hong Kong operation. So it's both the wealth management plus the the e-pension division. Yeah.
So this participant, Jen, is quite excited about your Hong Kong business. She's asking, can the Hong Kong business be bigger than your Singapore business?
I think if you look at some of the numbers here, like for example on the the net revenue targets, or even the profit before tax targets, they are fairly significant. So if you compare it to our net revenue, for the different countries like Singapore, then in a way, if you go into the next couple of years, the answer to that is yes. If you look at the revenue levels, yeah. Because if I go back to, let's say, the net revenue numbers for us, like even for Singapore, I think for 9 months of this year, it's been in the region of, let's say, 59 million at the net revenue level. So if you then compare it to some of the net revenue numbers for the Hong Kong division here, like going into 2024, so that's roughly about 150 million Sing dollars.
Okay, thanks for helping us to understand the Hong Kong business better. I think we'll move on to another geography. There's this question from Mr. Huang. Can you comment on your China business? Are you still looking actively at the China market?
Yes, so iFAST China, it's a business that we focus on by doing the B2B, and it's been a relatively difficult couple of years over there. So iFAST China is still a loss-making operation for us today, and I think there's a couple of challenges. So I think one is that if you look at the market sentiment that I was sharing a little bit at the global level, that sentiment basically deteriorating in the last couple of years because of the various issues with inflation, geopolitical tensions, the US China competition as well. So I think if you then zoom in on China, I think those challenges are even more magnified. And I think therefore the investor sentiment has been relatively lackluster and polar. And I think then when you translate that to the business that we run, then that has had a relatively difficult impact, or more challenging impact, on our business over there. So for us, it's still business as usual in terms of focusing and growing our B2B business in China. We have two main strategies that continue to be in place. So firstly, on the B2B side, we try to sign more B2B corporate partners to use our B2B platform. And then we hope that they will bring in sales and AUA. We earn revenues from that. The second one is tapping onto our advisory team that we call iFAST Global Markets, or IGM. So we have a team of advisors in China, and they can advise clients on their portfolios. So that continues. But of course, given the more challenging market conditions, we also want to be more careful on the cost part, the cost and operating expenses part of doing the business in China. So I think that is something that we've been looking at a lot more closely in the last couple of quarters for us. Yeah.
Okay, next we'll move to discussing the global bank in the UK. Maybe you can share what is the timeline that we're expecting the iFAST Global Bank in UK to be operational, and when are you expecting that to contribute towards your profit?
Yes, so the bank, when we acquired and completed the acquisition in March of last year, so it already had an existing business in place that continues to operate today, which is the remittance business. And that remittance business has been, in a way, the core business when we acquired it, when we acquired the bank. That continues today, and it's still an important, revenue contributor to the business. And we foresee in the next few quarters and years to actually improve that remittance business by, for example, looking for more clients, but also to bring in our fintech solutions and digitalize that part of the business to make it even better. What we have added, which was non-existent in the bank before our acquisition, is the digital transaction banking and the digital personal banking. So digital personal banking is a very B2C business. It's catering to investors around the world who want to open seamlessly an account online. And the reasons why perhaps they would want to do so is the convenience of having an online account open in a trusted jurisdiction like the UK, and the ability to then put their money into various major currencies like the pound sterling, the US dollar, Sing dollar, and so on, in the various deposits that the bank offers. And one group of customers that we can, that we see has been interested in using that digital personal banking service would be some of the clients in Hong Kong, especially those who have been looking to, migrate over to the UK. And also maybe they want to have their children studying in the UK, and therefore they need to have some pound sterling there as well. So the ability to open an account online seamlessly and then to enjoy very solid and decent rates on the various deposits, I think those are the major attractions in terms of why some of these clients have opened an online bank account with the iFAST Global Bank. The other business division, the DTB, the digital transaction banking, is a bit more B2B. Because actually, when we acquired the bank in the UK, it comes with the full banking licenses. We are also a member of certain services or platforms. So, for example, we're a member of the Faster Payment in the UK, and that enables us to attract other corporates or other B2B players to use our DTB platform for the various memberships on Faster Payment, for example, that we have. Because not all banks in the UK are on the faster payment infrastructure. So equivalent example in Singapore is the fast payment. So that's essentially what it means. And why would some of these B2B players want to use us is, well, they can connect to our service in faster payment, but also, of course, they can also enjoy a relatively good yield on their deposits or the safeguarding accounts, as we call it. And I think that's the kind of trend and progress we've seen for both divisions in the last couple of quarters, which have been encouraging.
Okay, I think we are almost running out of time, but we still have quite a number of questions. So maybe I'll take one final one relating to risk, given that we've been talking a lot about the different opportunities across different markets. Can you comment how interest rates affect iFAST business in both the B2C as well as the B2B business?
Yeah, I think for us, as a platform that is relatively simple, where it's reliant on pre-funding from clients before they can start to invest and trade in the various products. So historically, it would be, I think if you look at a stockbroker which relies on, let's say, your trading volume income, which can be quite volatile, but also secondly, the margin trading kind of income on the leverage part of their business. That is the part that we don't have to that we don't rely on at iFAST. So if you're looking at that perspective, for example, where interest rate go up and people are a bit more reluctant to pay for the higher interest rates to leverage, which is the kind of behavior we saw during the more bullish years, right, prior to the last couple of years, then that is a business that we have not been relying on. So we're not therefore negatively, let's say, impacted in that sense. And also on a very interesting note, if you look at our net revenue breakdown, the contribution from the net interest margin part of our business has actually gone up because as interest rates go up, then some of the solutions we offer on the cash accounts, we can pass higher interest rates to our clients so that they can enjoy higher interest rates on the various cash solutions. At the same time, we are able to still earn on the NIM, and that NIM has actually increased in a higher interest rate environment. Yeah. So I think that has been that is what we have observed in the last couple of years. And even if interest rates start to moderate or fall off, we have our usual core business revenues to rely on. But I think it's also maybe a bit premature to maybe from a more research point of view to assume that interest rates are going to decrease at a rapid rate going into 2024. I think some market participants may expect that, but we do not necessarily also think that is the case. Yeah.
Thanks so much for your sharing. In terms of, I think the macro outlook, the interest rate is definitely something that a lot of investors are looking out very closely for. With that, we will end today's session. I think we have been able to understand iFAST a lot better, both in terms of what's the difference between FSM1 versus IGM, your B2B versus your B2C business, what are you doing in Singapore, in terms of Hong Kong as well as the UK. So thanks so much for what you have actually discussed with us today.
Yes,
For
thank
all
you.
the participants, we hope you found today's Corporate Connect helpful. If you have any additional questions, please feel free to contact the investor relations team of the company. And if you missed any part of today's session, you can actually rewatch the webinar on SIAS YouTube channel. If you are not familiar with Corporate Connect, it is our monthly webinar where you'll be able to get updates directly from the companies and understand some of their key initiatives. The next upcoming Corporate Connect will feature First Read, and that will be on the 19th of December, so just before Christmas. So with that, I will end today's session. Thanks so much, JP, for sharing with us today. Thanks, Jihei, for the market update earlier. And I wish everyone a very pleasant evening. Thank you.
Thank you. Thank you to all investors. Bye-bye.
Hello.